So let's start with the macroeconomics perspectives. So GDP growth projections. IMF expects the world economy to grow at a rate of 3.2% in 2024 and 2025, having increased its forecast from 9 months ago by 0.2%. In 2023, both developed and developing countries performed better than expected, and in 2024, they will continue on the track. Developed economies are expected to grow by about 1.7% and developing countries at 4.2, 4.3%. We all remember how eventful the last 4 years were, starting with supply chain disruptions after pandemic, energy and food crisis triggered by the Russian invasion of Ukraine, a remarkable surge in inflation, followed by a global monetary policy tightening. But overall, despite gloomy projections, the global economy remains remarkably resilient with steady growth. But there is a clear divergence across countries. Growth in the euro area will rebound, but from very low levels, as past shocks and tight monetary policy weigh on activity. Traditionally, strong Northern European economies will continue underperform, while Greece, Spain, and Portugal are doing much better than expected. The strong recent performance of the United States reflects robust productivity growth and strong demand. But American economy remains overheated, inflation is way higher than expected. China's economy remains affected by the downturn in the property sector. What is happening in China is very similar to a Japanese lost 2 decades of the 90s. Domestic demand will remain weak in China. With depressed domestic demand, export and external surpluses will become the main source of growth. This, of course, will increase the risk of further trade tensions in an already fraught geopolitical environment. Many other large emerging market economies are performing strongly, benefiting from a reconfiguration of global supply chains and rising trade tensions between China and the United States. Median world inflation will decline from 2.8% in 2024 to 2.4% in 2025. Most indicators continue to point to a soft global landing. Despite the overall slowdown in inflation in G2 countries and in the euro area, there was an unexpected rebound in inflation in the United States in January-March 2024. American economy remains overheated with inflation at 3.5, 3.8%, and this most likely means that the Fed will delay its first rate cut to autumn 2024 instead of May or June, as was expected by the market. By contrast, in the Eurozone, the European Central Bank's first rate cut in June tends to be confirmed, inflation here being much lower than in the United States. It's around 2.4% in March. Looking at the construction sector, Eurozone construction is generally weak, especially residential construction. Overall, we see the increase of 0.5% in 2024, buildings down 2.1% year on year, and civil engineering is up 1%. Builders in Eurozone are waiting for the interest rate cuts to restart the projects. USA construction. Construction spending in the beginning of the year has declined slightly, unexpectedly as well, with strength in housing offset by weakness in non-residential and infrastructure. But overall, American market is doing great. Increasing output and surge in new permits point out to a record number of units to be built in 2024 in the United States. China. China's real estate sector is struggling to stabilize despite Chinese government implementing all types of financial and administrative measures to support the housing market. The 3 months average year-on-year decline in floor space sold went down to minus 23% in February. Floor space sales were down 24%. Typical Chinese model of borrowing money, building infrastructure, economic growth doesn't seem to work anymore. In the last few years, economists say that each 1% increase in the GDP was achieved through 4.4 to 5% increase in the borrowing. We will hear later from our colleague on the Chinese market, and it will be very interesting how people expect it to develop. India, on the contrary, based on the secondary indications, cement production, etc., the construction in India is gearing ahead with 4.8 to 10.2% annual growth. Again, we will hear a presentation on the Indian market later. It will be very interesting because that seems to be the market that's growing very fast. Okay, moving to the world steel production. According to the World Steel Association in 2022, world steel production decreased by around 6%, losing around 120 million tons. In 2023, a further decrease of 20 million tons took place. Looking at the changes in the production in 2024, which statistics have just been released for the first quarter, China reduced production 1.9% year-on-year in January-March 2024. And only in March, China reduced production by 7.8%. Other major traditional steel-producing countries, Japan, USA, South Korea, European Union, reduced production slightly by 0.6%, 1.9%. At the same time, for example, Brazil increased production by 6%, India increased by 9.7%, Iran 16.3%, and surprised Turkey by a record 28.4%. I will be very interested to hearing comments from our Turkish colleagues exactly what's going on there, how they managed to increase production in a weak market. And the topics that interest everyone, Chinese steel exports. As you all know, China mills are ramping up exports. Total steel exports from China in the first quarter of this year increased by 30% to the last year to 25.8 million tons. Every month this year, China exported more and more steel. Only in March, the exported amounted to 9.9 million tons. Based on the first quarter trend, China would be exporting around 103 million tons in 2024, which will be over, as Murat pointed out, the record 2015 export. At the same time, we see that long product consumption is going down. From the peak of consumption in 2021, long products have lost around 5.3% or around 50 million tons worldwide. In 2024, we expect to lose another 12 million tons, which is around 1.4%. Looking at the product mix, wire rods have lost around 33 million tons in consumption in 2024, and debars 23 million tons. Region-wise, Asia is losing a lot of consumption, and Europe is affected negatively as well. So that's a regional consumption of rebars. You can see Asia is losing a lot. Coming to the price trends. Interestingly, since our last conference, the prices remained quite stable, reacting very slowly to the changes in demand and in raw material prices. And the reason being is demand is very low. Buyers keep very low stock. Prices are relatively stable. Utilization rates at the mills are low, and there is no space for speculative price movements on the buyer sides or on the mill sides. International steel market seems to have divided into small regional niches, each niche defended with tariffs or quotas. All the time we hear about new market protective measures. In the beginning of the year, Turkey introduced a high import tariff on wire rods. European Union and the USA continue import quota systems. And just last week, Mexico announced high import tariffs on steel. Those protected domestic markets, small pockets of tranquility, allow mills to get by with reduced capacity, but at the same time, because of the reduced consumption and reduced demand, mills are not able to use their market power to increase the prices. This seems to be a new reality now. Reinforcing bar spread evolution. 2023 was tough on steel mills, and 2024 will be even tougher. Demand will not likely to recover until 2025. So far, mills managed to maintain their spreads by decreasing production, but demand will be low in 2024, and the raw materials will remain high. This situation is really not sustainable from the mill's point of view, but at the same time, only some extraordinary good news would be able to reawake the demand. No good news here, unfortunately. And look, to sum up the main factors of the world economy, someone said that the market is in a hibernation state. Everyone is waiting for good news, but they are unlikely to come in 2024. Tighter credit conditions, high interest costs have led to a sharp slowdown in housing activity in most major markets and have hampered manufacturing sector globally. Inflation in the USA is stronger than expected. It looks like Fed had decided not to reduce interest rates until at least autumn. So no relief coming from there. Economic conditions in China are not getting better. In March 2024, China exported a record number of steel. Profits, at the same time, they reduced production by 7.8%. And profits for the Chinese manufacturers have also become negative first time in 2024. This indicates a shortage of local demand in China. In the last 2-3 years, Chinese government tried all types of stimuli to revive domestic property market, but so far, looking at the property sales, they are not successful. Overcapacity is looming over Chinese industries. For example, car manufacturing. The BYD famous car manufacturing, which is short for Build Your Dream, will be producing 6.6 million electric vehicles in 2026. They aim for 10% market share in Europe and the USA. And there is even bigger overcapacity in the ICE, internal combustion engine in China. China has more than 100 ICE factories with a capacity to produce close to 40 million internal combustion cars a year. Just to put it in perspective, in total, only 18 million cars were sold in China last year. So when we talk about China being the biggest car exporter in the world with 5 million cars, potentially they can add another 22 million to that. I'm not sure what is the participation of all of us in the supply chains in the Chinese car industry, but I suspect it's zero. So it's a big problem for us. Also, this overcapacity and increase of export from China of all types of product, it will exacerbate geopolitical tensions and will lead to more trade restrictions for sure in the world. We hear, by the way, that the Chinese government is started investigation against export fraud in the VAT on steel exports. But my personal view that because exports is now the major source of growth in China, they will find a way, they will continue exporting. It's very unlikely that they reduce export. In Europe, on one hand, inflation has gone down from the peak of 2023. Contrary to what was predicted, energy costs in Europe have improved. For example, European gas prices have gone down to levels way below historical, and now they are much lower than what they were before the war started. But European economy remains weak. Traditional Northern European industrial powerhouses struggle with their energy-heavy industries and lack of domestic demand. They lose export market shares to Chinese competitors. Electricity prices also remain stubbornly high in Northern Europe. Rebar and wire rod consumption in Europe have decreased 20% last year. We will see if the expected reduction in the interest rate in June will revive the demand. This is our hope, but we are not sure. Also, geopolitical tensions becoming a problem now. Geopolitics are now firmly mixed with the economy. The world has become much less predictable and more dangerous. The number of conflicts that directly affect steel trade grows. A small regional conflict in the Red Sea led to a major disruption of the trade routes. The rivalry between the USA and China will continue to grow, and this will create many trading and political issues. Many countries will have to choose sides, and this will further isolate steel markets. So to sum up the prospects for our long products, we saw that the residential construction downturn, driven by the high interest rates and high construction costs, have dragged down steel demand across most major steel-using regions. Weakness in housing activity is expected to continue until the end of 2024 in most major markets, especially because Fed now decided not to decrease the interest rates. A recovery is expected in 2025. In manufacturing activity, the weakness on high cost and uncertainties, tight financial conditions, and strong competition from China also will continue the end of 2024. Automotive sector is a big concern, as we saw. Competition from China will affect all major auto-producing countries. Strong investment activity in manufacturing facilities and public infrastructure underpinned global steel demand in 2023. Investment was driven by major expansion of distribution companies and data centers. This will accelerate further in 2024-2025. But things can change very, very quickly. As an example, looking at the electrical vehicle industry, look at the headlines from June-July 2023, when the main concern in electric vehicles were shortage of rare elements, especially by lithium. So all the analysts were sure that the shortage of lithium would not allow electrical vehicle industry to develop. And then, in September 23, suddenly it all changed. The biggest lithium deposit was discovered in the United States, and now there is no more shortage of lithium in industry. So let's hope that the steel markets find its own lithium deposit in 2025. Thank you for your attention.
Alex, are there any questions from the floor for Alex? I have got one myself. Alex, how do you think the steel producers, particularly in the developed countries, can manage the problems and the issues that increasingly stringent environmental policies, particularly on carbon emissions, etc., will bring? How can they manage?
So from the point of view of, for example, the European producers, we have to follow very strict environmental regulations in Europe, and the governments are putting a lot of pressure on us on the emissions, and there is a big competition among European mills who is going to have the best EPD with the lowest carbon footprint. At the same time, material is entering Europe from Asian countries with huge levels of carbon footprint. So it's considered to be not a fair practice by European mills, which is debatable, but European Union introduced CBAM, which is basically a carbon border adjustment mechanism to try to level the field between European mills and mills from Asia mainly. And this mechanism will come into force in 2026. It's still a bit hazy how it's going to work, so I think we should really work on that at this conference, try to work out what's going to happen in the future. But for sure, it's already in place, it's coming, and it will affect everyone very quickly.
Certainly.
Very soon.
Thank you very much. Any questions from the floor for Alex? One. Do we have a question over there? No, I guess. Okay, one more question, if I may. You have mentioned that you expect the Chinese exports to continue, but I would like to have your guess. The Chinese have started this year at record high export levels. So if they continue like this, it will be a repetition of 2015. What's your expectation? Will they slow down a bit or continue at this pace?
I think there is going to be a temporary slowdown now for 1 or 2 months because of this investigation, which again, I would like to hear from our Chinese colleagues, because I only have the outside perspective, I don't have the inside perspective. But they will have to go back because the situation is so weak in China that they, in order to achieve the GDP growth, they have to export. They will find a way. That's my personal opinion.
Thank you very much, Alex.
Okay. Thank you.